In this chapter, we're going to look at how we construct a statement of cash flows. Now, you've learned how a business produces a balance sheet and an income statement. The balance sheet tells you what the business owns, who it owes, and how much equity the shareholders have in. The income statement tells you how much the company has earned in operations and how much they paid out. Those are very informative statements. But investors and creditors also know that some transactions are transactions that bring cash into the business, and some transactions are transactions where the business pays out cash. So following the cash, what transactions were sources of cash and what transactions of uses of cash is very informative. We understand that if the sources exceed the uses by 5,000, you would find a 5,000 increase in the cash account of the business. If the uses of cash exceeded the sources, the cash account would go down by that difference. So therefore, it's very important here then to follow the cash during the accounting period. Now there are three categories that we track here. One, operations. That is net income. Net income is your operating statement. Revenue minus expenses. Now, net income subtracts the expenses from the revenue, but not all expenses are cash, so we have to add back depreciation. Also, the statement of operations is supported by the company investing in accounts receivable and inventory. Now, did the company increase its investment in accounts receivable or inventory? That would be a use of cash. If they decreased it, it would be a source of cash. In addition, we have accounts payable. These represent accounts that are services and products produced or provided to us by other companies for which we haven't paid. So therefore, if we have increased our accounts payable, that means we haven't paid them. That means we've kept cash. So in effect, that's a source of cash. Secondly, then we look at investing. Investing in fixed assets. Did we increase our investment in plant and equipment or decrease it? And lastly, we look at financing. That is, did I borrow? Debt and equity. Did I borrow more money? That would cash in. Did I sell more shares? That would be cash out in. Did I pay dividends? It would be cash out, and so on. So let's begin with cash flows from operating statements. Just as I said, we have the cash received and the cash dispersed is on the net income. So the net income statement is revenue minus expenses gives me net income. But not all expenses are cash. For example, depreciation. We didn't pay cash for depreciation. Depreciation is just an adjusting entry. We debited depreciation expense and credited accumulated depreciation. There's no effect on cash, so we add that back to net income. Same with current assets. If we invested in current assets, we deduct that. So we're trying to convert net income to cash, and we do that by adjusting it for the accounts receivable and the inventory and the accounts payable. Let's go through a couple of examples here. The income statement for a company shows net income of $200,000. Okay, so we have $200,000. The merchandise inventory was on January 1st was $76,500, but it increased to $94,500. So that's an increase of $18,000. Well, that would be an investment. So therefore, that would be a use of cash. So we subtract $18,000. We're trying to figure out how much cash we have generated from operations. However, the accounts payable here was $57,000 and it went up to $68,000. So that means that we have actually a source of cash, and that would be $11,000. So when we add that all up, the cash from operations would be $193,000. In the second one, the operating expenses and taxes were $80,000 for depreciation. The net income was $350,000. Okay, $350,000. But to get down to net income, I deducted $80,000 in depreciation, so I add that back. And therefore, we say the adjustment is $430,000. Now we look at the investment in prepaid insurance. Now, prepaid insurance decreased from 18,000 to 14. So I've decreased my investment in that, which means I've saved some cash, 4,000. And the wages payable increased from 22 to 36. So again, I haven't paid the wages. In essence, I have stretched my accounts payable during this accounting period by 14,000. So I add that, 14,000. So the cash from operations here, 448,000. Well, let's take this financial statement of Bordeaux Company. Now, a company always produces two balance sheets and one income statement. Notice the balance sheet as the end of 2011 is these numbers. Now, the end of 2011 is the beginning of 2012, January 1st, 2012. So these are the changes during the year, and this is the income statement for the year. So that's all I need to track the cash. Now, what am I going to be doing here? Well, you will notice that the cash went from 20,000 to 35,000. So that's an increase of 15,000. All right. Well, let's start with cash from operations. Well, operations was 32,000. But they tell us that of the expenses that were deducted to get down to 32,000, 17,500 was depreciation. So I add back 17,500. Then for operations, I then look at accounts receivable. Accounts receivable changed by 6,000. Now it increased from 14 to 20, so that means it's a use of cash, and I bracket that. Inventory increased 8,000, and I bracket that because that too is a use. I increased my investment in inventory. I go down here to accounts payable. Now accounts payable went from 15 to 19, a difference of 4,000, and that is a source of cash because I'm stretching my accounts payable. And then income tax payable went down 1,000. That is a use of cash, and I bracket that. So that's operations: accounts receivable, inventory, accounts payable, income tax payable, and of course the income statement. Those are operations. Then we look at investment. Investment in plant and equipment. Did it increase or decrease? Well, in this case, they said it decreased. It went down 8,500 is what they say down here. So therefore, it is a source of cash. I leave that bracketed, unbracketed, 8,500. Finally, I look at financing. Financing is debt, which is bonds payable or bank loan payable, and common stock. Now, this common stock, it should have been 18,000 for. So this is financing activities. Now, what happened? Bonds payable went from 33 down to 17. Well, I paid that off. So that is a 16,000 use of cash. Oh, can't get this to work properly. That's 16,000 use of cash. And common stock went up 14,000 to 18,000, so that is a 4,000 source of cash. And lastly, they said down here that we paid dividends of 20,000, so that would be a use of cash. Now we put it all together. This is what it would look like if we did it properly and neatly. Here's the statement of cash flows from operations. There's your net income. Add back your depreciation. Another source is your increase in accounts payable. A use is a decrease in income tax payable, a increase in inventory, and an increase in accounts receivable. So you can see that this company generated $38,500 from operations. Where did they spend it? Well, they didn't spend it on sale of equipment. They didn't spend it in investing because they sold the equipment. So that's more money. They had $38,500 plus $8,500. Now, in financing, they issued more stock, so that's a source. But they redeemed the bonds, which means they bought them back, so that is a use. And they paid dividends. So the total amount of uses was 32. So 38,500 plus 8,500 minus 32 is 15,000. And 15,000 positive, that's cash in over cash out. And the cash at the beginning of the year was 20,000, at the end of the year is 35, and I have therefore explained the change in cash flow.